Today's sales strategy. If something important you believe to be true turns out to be wrong, when would you want to know about it? Hi everyone, I'm Steve Savant, host of the daily talk show, Let's Get Down to Business.
And I'm Don Prince, Senior Advisor to Ensmark.
Well, Don, we're talking about something really cool today, and this is the longest title I've ever seen. Hopefully we can shorten in the blog when it goes to the internet. It says, what happens if something important you believe in, that you believe to be true, turns out to be wrong? When would you want to know it? Don, when would you want to know?
Immediately.
You'd want to know immediately. I think most clients would say the same thing. I want you to look at what's out on the internet about cash value permanent insurance. It says cash value life insurance is a ripoff. Only a financial idiot would buy it. Or it's better to buy term insurance and invest the difference. Or, by the way, a little side note, nobody ever invests the difference. There's a whole nother issue, but okay.
Agreed.
And then the last one, why would you spend thousands of dollars for something you could get for a few $100s? Or maybe you've heard Susie Orman say repeatedly, I hate whole life insurance, I hate universal life insurance, I hate variable life insurance. I noticed that on here it doesn't say anything about indexing. She has the only type I like is term insurance. Now, is there any real validity, economic validity to this theory? Well, we're looking at George Baker. His age is 45, and he's in the 40% marginal tax bracket. He plans to purchase $500,000 of index universal life with scheduled premiums of $20,000 a year for the first 20 years, zero thereafter. Cash values are illustrated growing at about 7.5%, and the policy is intended to provide protection for his family, after-tax cash flow of $60,000 a year from ages 65 to 95. And I want to look at why one of his advisors says to George, why would you spend 20 grand on an index universal life program for coverage when you could do it for $600?
That's a good question.
I think it's a good question. And remember, you have to say, if somebody asks you a question why, if there's 20,000 going into a policy versus 600, you better have a monster value proposition. Would you not agree?
I would agree.
It's because the disparity is too great.
Sure.
Now, if that's all that we're talking about, I understand, but it shouldn't be, and it isn't. Actually, let me tell you it's not obvious to most Americans, because the humorist Josh Billings says, it ain't ignorance causes so much trouble, it's folks knowing so much that ain't so. Is it so? Is buying term investing difference the way to go? Is term the only way to do this? And let's look at this. We compared George's indexed universal life to a $500,000 20-year term at $600. The term insurance alternative assumes a side fund yielding 6.5% taxable and $19,400 a year. The difference between the $20,000 premium and the index universal life is the $600 premium in term. And by the way, when we show the comparison, we back out that cost on our side of the equation too, to be fair. In order to match the term and the side fund, with the $60,000 in cash flow from the index universal life, we've put them side by side to see if we can deliver the same $60,000, which is our end game here. It's an income play, and look at which one does the best. I already know going in that the cards are stacked in our favor, but let's just look at the statistics and talk about it from a strictly math point of view. Don?
Sure. And of course, term insurance makes sense if you don't have the cash available to buy anything else, because you want to be able to protect your family if something happens to you. What we're really talking about is people that have the financial wherewithal to buy whatever they want, but perceive cash value life insurance as a bad investment. And when you look at the way the tax laws are in this country, with the tax accumulation, the tax-free distribution of withdrawals up to basis, tax-free loans, tax-free death benefit, you look at the fact that all of your mortality charges in cash value policies are paid with pre-tax interest. When you buy term insurance, you have to earn your money, pay your tax, and then pay your premium. All of the charges, mortality charges inside of cash value policies are pre-tax interest. In Canada, I don't know if you know this, Steve, in Canada, they make you reduce your basis by the cumulative mortality charge. So when you get that money out, they tax you on the basis less the cumulative mortality, because they understand that this is such a huge advantage, especially as you get older and those mortality charges get high. The ability to pay those with investment interest that is never taxed is very significant. And so those are some of this isn't magic. These are structural tax incentives with cash value life insurance, and that's why the numbers look like this. Let's look through it. With the term policy, again, same premium in, 20 pay, and then starting in the 21st year, we're taking $60,000 out a year tax-free. The term and the side fund lasts 21 years, and then there's nothing there. They're able to pay out $699,000 in cash out of the side fund, and then they're both gone in year 21. With the cash value life insurance policy, Instead of $700,000 of tax-free cash, we're able to pull out $1.2 million, almost double, and the policy's still in force in 40 years with $637,000 of death benefit and $600,000 in cash value. I don't know how anybody can look at this and say, yeah, but I don't want to listen to this. I only want to buy term insurance because it's cheaper. I don't know how you get there from here.
Yeah, the balance sheets are very, very, very fair when we try to do this through Innsmark and also their sister company, Wealthy and Wise, because both products always display things like this in a very fair and I think logical and mathematical way. I want you to look at this because even if you're a termite today, the math is the math. Can I do this? Remember, the leverage that we have in the tax issue at the tax code alone is huge. Then you're talking about the pre-tax payment of the interest that we are talking about. And then on top of that, if you're using indexed universal life and you're using participating loans, well, we're just stacking the deck for us to win on a long-term play. Remember, I'm not talking about a short-term investment here. I'm not even talking about kind of a short to mid-term. When I'm looking at insurance like this, I really want to look at long-term thinking, 20 years, 25, 30 years. That's when our numbers really work. Walk me through this graph. I love this summary, this 50-year summary on this. This is really quite outstanding.
This is a summary produced by the Innsmark software. We have a permanent versus term illustration, and this is one of our graphics. We like graphics. We think it's easy to have people understand. And what this is showing is term insurance in a side fund is able to pay out $700,000 of retirement income. Same payments in, we're going to put $400,000 into that plan. Same $400,000 into the cash value index universal life. It can pay out $1.8 million of tax-free distributions. Down here, this plan, the term and a side fund runs out of money in year 21. Our plan in year 50 is still going strong. And so that's what it's showing.
When you look at the comparison between term and investing the difference in a taxable fund, and you're looking at indexed universal life, which is a tax deferred and the ability to take out money tax-free with withdrawals of basis and policy loans to gain, I'm telling you that the numbers here, using everything else as equal, is a stark reminder that it's true, that if you believe something that you've been thought was true for all your life and you found out that it was not true, when would you want to know it? Well, Steve and Don just told you. Today's sales idea is brought to you by Ash Brokerage, the practice enhancement company.
And by Innsmark, the most widely used software when it comes to strategies and presentations using cash value life insurance.